2019 closed out the decade, but according to our next guest, it also represented a historic change to the Federal Reserve's approach to policy. Joining us now to share what this means for markets moving forward is Brown Advisory's head of fixed income, Tom Graff. Tom, good to see you. Thanks for joining us.
Great to be on.
Talk to me about how the Fed did change its policy last year and what that is going to mean for markets and investors this year.
Well, it feels like a long time ago, but if we remember just 1 year ago, we thought the Fed was going to be hiking several times in 2019, despite how rough a fourth quarter the stock market had at the end of 2018. Around that time, the Fed did a real soul searching and has decided that it's better to stave off a slowdown than to fight inflation preemptively. And so going forward, I think we're going to see a Fed that's less activist when the economy is strong and more activist when the economy is soft.
So, Tom, does that mean that A, it learned its lesson from what happened last year, or B, it's because Jay Powell has finally been cowed by President Trump, or C, both? And, what does this mean? I mean, we're just going to have easy money forever?
I think there's been a real shift in how economists generally think about monetary policy. I think with the 1970s now looking more like the outlier than what the playbook should be based on. I think that's the real change. I don't think it has a lot to do with politics. And I will give Jay Powell credit, him not being part of academia, not sort of coming in with a lot of priors. I think he was able to change his mind upon seeing new evidence. In terms of whether it's going to be easy money forever, I mean, that depends on how you think of what's easy. If we look around the world, U.S. rates are still higher than pretty much everywhere else. So relatively, our money is not that easy, and that actually does make a difference into how things work. So I'm not sure I'd call it easy money forever, but I do think Fed is going to be more supportive of risk markets than they were in the past.
I mean, U.S. rates are higher, but as you point out, if you look globally, whether it's the ECB or the Bank of Japan, they've made it pretty clear they're going to stay in an easing stance for a bit longer. So doesn't that essentially force the Fed's hand as well?
Well, I think what it means is that if the Fed were to hike, that would have an outsized effect versus what it might have if the rest of the world were hiking also. So really by doing nothing, they're just sort of keeping a steady state. And to your point, I think the only reason why rates are a little bit higher in the last 3 months or so in the U.S. is because we took some recession odds out, which is appropriate based on how the data has come through. But what we haven't done is started to price in rate hikes. I think that would be a completely different ballgame and something that's highly unlikely in 2020.
And Tom, you talk about sector level and company level events mattering more than macro at this point. Why is that?
Right. Well, so if the Fed is the dominant factor in whether we have a recession or expansion, then that's going to affect all companies all the time. Whereas if the Fed is going to be less activist at this point, then what we could see is more industry level slowdowns or expansions, which will really change how investors need to approach markets. Instead of thinking of just risk on or risk off and that dominating your decision making, you're going to have to think about whether this industry is in a good position or whether that industry is in a good position. We saw an industry level recession in late 2015 into 2016 in the energy business and related sectors. We could see more of that as opposed to seeing the classic recession in the coming years.
All right, we're going to leave it there. Tom Graff, portfolio manager of the Brown Advisory. Thanks so much for stopping by today. And I also want to thank our editor-in-chief, Andy Serwer, for being with us for this hour. It was fun. Thanks, Andy.
Yeah. Hey, investors. Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.